Hello traders, this is Julius. Today I want us to talk about liquidity inducement. What exactly is inducement? What occurs during inducement and types of inducement? And in the most basic way, inducement is the act of liquidity being engineered around the area of where the price wants to go. Prior to approaching to the zone or the level where the price wants to go and transact orders, what I call orders fulfillment, it needs to make a few stops, which are a form of inducing traders to make a mistake and force an early entry. Price will react from a level or a zone near the intended level or zone to entice traders into taking early positions. And when we talk of inducement, we have different types of inducement. We have what we call, but before we get to the types of inducements, let's talk of basically what that inducement is. Like in this scenario, we have the market testing this level. We know that this is the actual transacting point where the market wants to go. But prior to that, the market formed a high at this point, formed another high and another high. That is 3 highs, or what we call the equal highs, before taking these positions out. And what do we know? Basically, what do we have at the back of our minds? That every time when the market forms a double top, we are most likely to sell from the zone. So when the market is revisiting this point, we are likely to sell from there. But according to me, that is not the best time that someone is supposed to short the market based on the double tops or long the market based on the double bottoms. Because most of the time, the price will react as if it is dropping from that zone. And assuming we have a zone up here, the market will just rally, take out the stops, and then react from here to continue downwards. Now the market will go to the intended direction without you. So that is the case of what we call inducement. And out of that, I said we have different types of inducement. Like in the first case here, we had the market having the actual point, or what I call the point of interest, or POI, that the market was intending to sell from here. But before selling from here, we had the market faking the sell from this distance. So we add the first point, the second point, the third point, only for the market to sell a little bit to trap both buyers and sellers, and then proceeds, or what we call the purge or the stop loss hunt. In most cases, that is not how I define it, but I've heard most of the traders call it that way. Then all the way to the transacting point and the market drops. Before we get into, okay, let's forget to the types of inducement. So the types of inducement, we have 3 types or more. We have what we call the single high, low inducement. We have 2 highs or 2 lows inducement. And then we have that is it. So we have the single high where the market now, instead of forming double tops or whatever, it just makes this first high. And maybe the orders here are enough to transact this, or maybe for the market to move. So the market will form a single high and then proceed to take it out and then react from this point. Because in this scenario, we have the market behaving this way. So we know if the market is coming back up here, this is this scenario, we know that the market is going to sell from this point. So the market comes, and instead of selling from here, it might fake a small move and then proceeds to the actual point of interest or the actual selling point. That is the first scenario. And I think this is what is holding most of the traders, because that is how we trade. Every time when we think of a high and the market is coming back to that high, we think of selling the point. That is always a trap. The other case is where we have double highs or double tops. So we have the market proceeding before getting to the point of interest, assuming we have our point of interest there, or the actual selling point, in case this is a buying market. So the market will come back to this point and react again from this point. But we have an exception that the market should not take this point out. if it takes that point out, there is a probability that this is a strong point and the market might continue downwards. We want to see the market bouncing from the eye and then pushing again towards the eye without taking this low out. So the market now forms the first eye, the second eye, and now the triple, the second eye, and the market is coming the third time. Instead of the market selling from there, it proceeds to sell from here and then continues downwards. So what happens in this case? The market has trapped both the sellers and the buyers. Like in this case, when the buyers came to this, the sellers came to this point and found that the market has formed a double top, they knew that the very next time when the market is visiting that zone, it might sell from the zone. But instead, what happens? The market takes it off. So the sellers now are being trapped at this point because they were expecting the market to sell. Some of them who are aggressive traders might have taken the position to sell. And then the buyers now comes into the market. And then they see that the market has already taken out the double tops. What are they expecting? The market to continue buying. So the market buys to a point, and then from that point, it proceeds downwards, also trapping the buyers. So we need to be very careful when it comes to inducement, because that is how the smart money is operating. And basically, I want to believe that we all know the smart money. These are now the institutional traders who are now trying to make money or make something from the other institutional traders. Because in this market, it is a market based on who has power than who, but not compared to the retail traders. We just come into the market, we the retail traders, just to play smart and make something from the market. The other type of inducement is what we call the triple highs or the multiple highs. Could be 3 highs, 4 highs, 6 highs, and so on and so forth. It is your responsibility as a trader to choose which form of liquidity are you going to trade with. Like personally, I always trade if the market gives me, if the market is approaching a point for the second time, I will take the position. But if the market is approaching that specific point for more than 2 times, I am not going to take that position. Like in this case, I would have checked the market to give me a high and another high. These were now 2 times. And now the third time when the market was approaching this level, I would not take this sell because the chances are, if that point was strong, if that point had enough liquidity to move that market, the price would not come back to the zone. So that is how I ensure that I am playing it in the best way possible or in the safest way possible. So that is the case. Now, apart from having 3 highs, then we could even be having something like 4. Like in this case, we have the market coming the first time, coming the second time, coming the third time, and also the 4th time before taking the point out to sell. That is the scenario and the case that we have when it comes to inducement. I think I have tried to be brief. We have more courses to go. So let's go now to a real chart and see what exactly this inducement looks like in a real chart, because this kind of an example or kind of a scenario looks to be so perfect. Let's go to a real chart. And we are going to start with the 2 charts. Remember, I said I'll be looking mostly in gold and the US oil. So like in this case, now we have gold. This is a golden chart, or maybe for gold. What can we say about this? That the market is trying to form an inducement. We have this actual selling point. We have this actual selling point. Let's just have a look at this one right here. So we have the market. We have the market forming this, assuming that this is the origin of the entire move. So when the market bounced from there and it is now approaching the zone again, then we had this inducement happening here, or the traders were being enticed to take positions earlier. So we had this eye, and this eye. So this is 3 times, only for the market to take out the point to the actual selling point, because this was the selling point that we were looking for. So this is a kind of a multiple high liquidity. Let's have a look at exactly what is happening in the current chart. So we have the market. We have this as our actual trading point. This is the actual trading point. So the market forms the first high. Then what are we expecting? That the market now should take out this high. Like in this scenario, this now will be what we call now the single high inducement. So after the market forming that high, I'm expecting the market to proceed all the way up to this point. And that is what I said on the weekly analysis, the videos, that I'm expecting to sell gold from 2050, 2056. So that is exactly what is most likely to happen. That this is the first time that the market is approaching this, but I also have an expectation that I might be having a double top kind of inducement in this case, because I'm expecting the market to pull back all the way to this point around 1980s before I buy to this point, and then I sell from this point maybe to a lower point. That is the expectation. But we can have a check at a different chart, maybe a chart like the US oil. These are the two charts I will always be paying attention to. So this is the US oil. We have the exact types, but in most cases, the US oil, if you get to trade an instrument for a while, you get to know the kind of a behavior or the kind of the nature of its movement, whether it's using by either a single kind of liquidity or double liquidity or triple liquidity or multiple liquidity, then you will get to notice how that pair moves. Like in this case, we have oil. And oil in most cases uses that kind of liquidity where we have just a single high or a single low being taken out, the market proceeding, creating a high, taking out the high, and the market proceeding, and that kind of movement. Here we have, so we have, let's just take this as a possible scenario where this market is falling from a point. Let's assume this is a starting point. We have the market now forming this point. Let me just call it a fake point, and then dropping to take the point out. Then we have the market pulling back to a point, and then maybe giving us this as a high. The market proceeds to take it out at this point, gives us a high. And also from this high, before it is taken out, we have this low. So the market proceeds to take out the low and also proceeds to take out now the high. Now we also have the market originating from this point, making a fake high, pulling back to this point before proceeding all the way to take the high out. And the same case or the same continues. So we have the market starting maybe from a point, making a high, pulling back to a point, and then buying to take that point out. And also the market pulling back to this point, proceeding to take that point out, and all that kind of a movement. So that is how inducement looks like. So ensure that if you have not subscribed to the videos or to our channel, ensure that you subscribe, ensure you follow. There is also a trading channel that we have, it's for free. So I leave the link on the description below so that you can join the community. It's good as a trader to trade with a community.